I recently received a comment from Vijay who said, "Thanks for the great video. Is there any chance you can please make a video on investment property explaining about paying interest only or principal interest both? Thanks." Well, Vijay, this is that episode. Hi, it's Nero here from Investment Rise. And when it comes to trying to work out whether you should go interest only or principal and interest when buying an investment property, there are a few things you need to consider. The first thing is an actual mindset shift. You see, most of us have been brought up with this whole philosophy of all debt is bad, pay off debt, get out of debt. Okay, and so when we come to then thinking about what kind of loan arrangement we should have on an investment property, we naturally think principal interest is best. But that isn't always the case. So let me draw up a couple of scenarios here that may help you decide what's best for you. Now again, nothing that I'm sharing is advice, of course, because I don't know your personal situation, but after having invested in property now for over 20 years, and I've been helping people invest in property now for over 12 years, I found that often getting the finance structure right and then understanding how debt and money works can help people actually pay off their mortgage faster and also help them with their cash flow. So if that's what you're after, then I really hope this episode is going to be helpful. So let's begin by looking at an example where you have your home, okay, and let's say your home is valued at $1 million, okay, just to keep my numbers easy. You have a mortgage of $600,000, so mort equals $600,000, and then you've gone and taken some equity out to buy an investment property. Now, if you're not sure how to work out how much equity you have, go and check out my earlier episode where I talk about exactly how to calculate how much equity you have and how to use it to actually build wealth, okay? But in this scenario, let's assume that you go out and you take out, say, equity of $140,000, 140K, okay? And then you use that as a 20% deposit plus your stamp duty and everything else, and you buy an investment property here for $600,000, right? Okay, IP is $600,000, and your loan over here is $480,000. So that's 80% of the investment property. Then, as I said, the 20% plus costs come from here. Okay, so in total on day one, you bought an investment property for $600,000, but your total debt has actually increased by 480 plus 140 is $620,000. Okay, so now the question is, well, should you go interest only on your investment property or principal and interest? Well, consider this. The debt on your home, this initial $600,000, that's not tax deductible at all, right, in Australia, okay? There you get no financial benefits from this $600,000. Of course, you do get a roof over your head, but no financial benefits whatsoever. But this debt here is actually tax deductible because you've incurred the debt for the purpose of buying an investment property. Now, I am not suggesting that you buy property just for tax purposes, okay? I'm just explaining to you how the debt is considered, okay? So therefore, which debt is actually more painful? The debt that you get tax deductions for or the debt that you don't get tax deductions for, right? It's pretty obvious, right? The debt that you don't get tax deductions for, okay? Plus, I'm sure you'd feel a lot better if you didn't have a mortgage sitting on your house, okay? So here's what I would recommend if this is your scenario, okay? Number one, you would keep your mortgage on your home, principal and interest. So you would keep paying that down. You would make this loan over here interest only, IO, okay? So that means that you're not actually going to pay this debt off, okay? Your focus is to pay this off. And if you've got extra cash flow each month, once you've got an investment property, you want to direct as much of that extra cash flow into here, okay? Doesn't make sense for you to put it into here and pay down tax deductible debt and then lose out on some of the tax deductions when you can actually pay off your home loan first and foremost. Now, of course, you are going to make the interest payments here though, okay? The interest is a cost of borrowing, in this case, $480,000, all right? So interest only over here, principal and interest. But what about this 140 over here? And why have I got it separate? You'll notice I haven't said pay off 600 plus 140 as in 740. I've actually kept it separate. Why? Because if you structure yourself correctly, okay, and you essentially have this as a separate loan account, so this would be loan account 1, which is your personal home loan. This could be like an equity loan or whatever you want to call it, okay? You could actually claim this interest as a tax deduction as well. So yes, even though this $140,000 is secured against your home, because you're using it for the purpose of buying an investment property, if you keep this separate, so it's very clear that you only use this debt for an investment property, then you could claim this as a tax deduction, okay? So then you could theoretically, depending on your personal preference and also what your bank allows as well, could you make this interest only or principal interest? So that's going to depend on your situation, okay? But the key thing is that this investment property, even if it's with the same bank as your home is, you need to make sure this is interest only, because you want to maximize your cash flow to pay off your mortgage more quickly, okay? Plus, if your goal is to build a property portfolio, okay, and you have bought well and you bought in an area that's got good capital growth drivers and the property's going to rise in value, okay, so say it rises in value now, okay, and let's just make this up for now, and let's say now a few years has elapsed and the property's now worth $800,000, okay, and you want to go and take out some equity again, okay, to go and buy property number 2, okay, in this scenario, what have you just done? Well, you've just gone back and increased the debt on this property, right? So why were you then working hard and struggling from a cash flow perspective to pay it down, only to then go and take the debt back out again to continue to build wealth? Wouldn't it have been better for you to take the money that you might have been paying off on this loan to put it over here? But many people will then say, oh, but Niro, my bank will only give me 5 years interest only, which is pretty standard these days. Yes, some lenders will give you a bit more. Other times banks won't even give you 5 years interest only. They may only give you 3 years, for example, because of how they work out your borrowing capacity. Doesn't matter. Whatever the situation is, however long you can get interest only, take it, because it allows you to maximize your cash flow, okay? And then what happens when it has to go principal interest? Well, again, if you've bought well, and your property has risen in value, okay, and if your rents have risen in value, well then you can then look at the numbers and go, okay, if it's now got to be principal interest, will the increase in rent pay for that increased repayment now they've gone from interest only to principal interest? Number 1. Number 2, if you're able to, you could always refinance this to another bank, right, and start the interest only period over again, okay? I can't tell you the number of times I've refinanced some of my investment properties when I was in the period of acquiring. So I was building my portfolio, okay? So, you know, when I went to say my first 3 properties and then I had to wait. So when I'm then in my waiting phase, then I might go to principal interest depending on my situation. But when you're building a portfolio, okay, and that's your goal, and you have a mortgage, then focus on paying this off faster. Keep these interest only. But what happens though if you're in a scenario where you have paid this off, okay? So this is now gone. You don't have any personal debt against your home. Well, first of all, congratulations if that's the position you're in. So therefore, then the only debt you have is investment debt, whether it's secured against your investment property or against your home. In this scenario, I would also go interest only, okay? Why? Because your first goal is that yes, you've used the equity against your home to buy an investment property, but as fast as possible, you want to move this debt over against other properties, right? So what I mean by that is as these properties rise in value, and then depending on your goals, you're either going to use the equity against the properties to buy more, or there'll come a time and you go, look, we're done for now, and you're instead going to refinance these properties, and you might take out an extra 140K against this property for argument's sake, okay? Take that, clear this, and now all your debt is sitting against your investment properties, okay? Or of course you might have got multiple properties and you may sell 1 or 2 to pay off this debt, all right? It doesn't really matter. The key thing is to understand that you don't need to go principal and interest on your investment properties, okay? You've got to ask yourself, what's the benefit? For most of us, we think we have to do it because, as I said at the start, we've been taught that we need to pay off all debt, Okay, remember, investment properties, some of them you are going to sell. I know people out there will say, oh, never, ever, ever sell. And look, that might have worked when the average property price around Australia was $300,000 or so. Today, across capital cities at the very least, the median house price is about $1 million. Okay, so thinking you can keep buying and buying and buying without ever selling, unless you're doing development or something more advanced, it's just very unrealistic. Okay, so if you're looking to sell at least one or more of these investment properties, then you'll extinguish the debt at that point. So there's no reason to go principal and interest to begin with. Okay, so hopefully that helps sort of clarify, should you go interest only or principal and interest. Essentially, the takeaway message is, if you have a mortgage on your home, go interest only on your investment properties to help you with cash flow and pay off your mortgage faster. If you're looking to build a property portfolio as fast as you can, then odds are you'll probably go interest only as well. The only time you would convert these to principal and interest is if you're at a stage where you either don't have a mortgage anymore on your personal home, and or you are now looking to consolidate, pay down debt, you built a portfolio, and now you are looking to just build equity as fast as possible without acquiring properties. Hi, it's Nero here again, and thanks so much for watching. If you like what you saw and you're looking for a proven recipe, a blueprint on how to build a property portfolio that gives you passive income, then click the link below this video and get a copy of my book, Wake Up Wealthier, How to Build a Property Portfolio that pays you an income each and every month. Okay, when you click the link and you download your book, you can get both the digital version and the audio version in case you don't like reading. All right, so I used to sell this book for $49, but right now I'm making it totally free. Why? Because I want more people to get this information, and I know that a segment of you will then like what you see in the book and choose to reach out to find out more about our services. But even if you don't, if you're serious about building a property portfolio that pays your passive income, then you really want to get my book, Wake Up Wealthier. It contains the secrets that I have fine-tuned over the last 19 years. It's totally free for a limited time. Click the link below.